Hello and welcome back to the Note. Are we going to have a stock pickers market in 2014? Now, there's a lot of people that are predicting this, that as the crisis recedes, stocks will become more discerning. They'll vary more after many years when correlation was very high. Everything was rather driven by top-down macro factors, making it extremely hard for active managers to outperform their index. And we can illustrate this for you with this very interesting chart from Goldman Sachs. It shows you the degree to which every stock in the main indices in Europe and the US was correlated with every other stock. And you can see that correlations spiked to very high levels, somewhat higher in the US than in Europe, both after Lehman Brothers went down and then again during the worst of the Eurozone crisis. You can also see that those correlations are now reducing very substantially, even if they're not quite as low as they have been. Now, that spiking correlation we've seen is a truly historic one, as we can show you with this chart from JP Morgan, which is just for the US and goes back all the way to 1926. You can see, first of all, that yes, this spiking correlation was the highest ever. You can also see that correlation tends to be high when the market has crashed. It was very high in 1929, it was high before the Black Monday crash of '87, and it's been high again most recently. Volatility and correlation tend to go together. We can illustrate that for you with another chart from JP Morgan, which compares correlation on the Dow Jones Industrial Average with the VIX index of stock market volatility. There is an interesting problem here, however, which is that when volatility is high, even if correlation is also high, there can be a big opportunity to make money. Even if every stock goes in the same direction, you can, if their performance is wide enough, you can make money. That, for one example of that, take a look at what happened in 2008 when the banks led the market down. If you either avoided the banks or actively bet against them, it was possible to outperform very significantly during those very difficult months. Now, S&P Dow Jones indices have looked at this concept. They call it dispersion, and they've produced some very interesting data on it, which unfortunately is rather concerning for active managers. What we're looking at here is their measure of dispersion, the tendency for the ultimate performance of stocks to vary, compared to the VIX, which is the red line here. And you can see that dispersion has fallen to the lowest levels since they've been measuring it in the last few months. If stocks' returns are barely dispersed, if they're not particularly correlated with each other, they're not moving in the same direction at the same time, but the differences are still not that great, it's still very hard for an active manager to show that they've really gained something by making stock picks, by stock selection. We can illustrate that for you with this chart from S&P Dow Jones, which compares how dispersion varies over time with their concept of active spread, which you can see in the bars. That is the difference in performance between funds in the 75th percentile, the best quarter of performing funds, and the 25th percentile, the worst performing quarter. You can see that quite clearly when dispersion rises, so the better or maybe luckier active managers can show their worth much more. However, and this is another serious problem, unfortunately, for the active fund management industry, there's no particular evidence that high dispersion makes it any easier to actually beat the index. This is another chart from S&P Dow Jones, and you can see that there were 2 years out of the 10 they were looking at when the average fund did beat its benchmark. That's no great surprise. Usually, as lots of research will tell you, most active funds fail to beat their benchmark. And there was no particular link to dispersion. Now, is there any particular reason to hope that this situation will change in 2014? Well, yes, there is. Volatility is extremely low, and it tends to spike up quite quickly once it's been this low. And we're now entering, we'll be entering the 6th year of the bull run since the worst of the crisis after Lehman. As bull markets get to their end, they tend to get more volatile. There tends to be more opportunity for the best active managers to outperform. That's what you saw in the late 90s when those who chose tech stocks and dot-com stocks did very well for a while. The bad news, of course, is that if we are near the top of a bull market, then you get very difficult decisions on timing. What makes sense for the next year or so might make very much less sense over a longer time horizon. And in general, people in the asset management world would rather that the bull market didn't come to an end. So ultimately, despite the very dramatic reduction in correlation, despite the very good evidence that the crisis conditions are receding, I'm sorry to say that it still doesn't look as though this will be a good traditional stock pickers market this year.